So I'll go ahead and review today's price action. I'll start with looking at the daily chart. The biggest thing on our screen is still this big sell-off from the FOMC announcement on the 18th. We have this big bear bar. It's the biggest bar on the chart, so it's going to continue to be an important part of our trading. You can see I have this measured move drawn from the open of that bar to the close, and that puts us down here around the 200 moving average. And we're expecting at least a little bit more selling after this. This could be the minimum amount of selling that we'll get, and then possibly a reversal up from here. Or I think more likely is that we'll probably have a little bit more down, possibly down to these lows. And then, of course, the bigger target is down here around 57.30 and around the 200 moving average. Looking at for today's trading. So coming in today, this is what the daily chart was looking at. And the market opened in the middle of yesterday's range. So when I'm looking at that, I'm looking at the high of yesterday and the low of yesterday being important prices and important targets for that day to hit. So pulling up the 5-minute chart, the highs and lows of yesterday I have drawn in with these red lines here. And notice early in the day, the market went up and it went above that. So it hit that target. And then a couple hours later, it went down and it hit the lower target. And so the market will often do that, especially when it opens in the middle of the range. And something I'll say a lot is that when the market opens within yesterday's range, it increases the chance of today being a trading range. And that's the reason, is because there are targets above and below. And so the market will often test one and then head down to the other, which creates this back and forth motion and hence a trading range. Looking at our first two bars today, two strong bear bars. When you see that, often it's reasonable to take a short trade. I wasn't so interested in getting short here because it's coming right down to the open, to the close of the prior day and to the moving average. So a lot of this is just the market coming back down to test the close of that day. And because of that, I'm not too interested in getting short because I feel like people were shorting up here, wanting for the market to get down here. There might not be that much shorting left to happen. I want to talk about trend versus trading range, and I think kind of a unique way that you can identify whether you're in a trend or a trading range. Let me go back a couple days. So I'm going to start with this day. The first half of this day was a downtrend. And look at the bull bars. Each time there was a bull bar, it was sold. Bull bar here, it was sold and sold. Bull bar here, it was sold. And people that sold here would sell more higher. And they got out with a profit or break even down here. Bull bar, they sold or sold higher at the moving average and after this big bull bar, and they made a profit here. They were able to sell here. They were able to sell through here and get out break even or sell more higher and try to get out at their midpoint. And that keeps happening until then, instead of the bull bars getting sold, it is now the bear bars that are getting bought. So we can see these bear bars down here. This one was bought. This was bought and bought. And then now we're above the moving average and bear bars are getting bought here and here and here. And then ultimately that ends up being a bull trend. So that's one way that you can identify if you're in a trend, is when one side, every attempt they make, they are losing money. And when you can see that clearly the way to make money in this market is just selling any bull close. So you can tell then this is a bear trend. Then as the market's moving up, every bear close is bought, then you can tell that you're in a bull trend. We can look at the next day as an example as well. On the open, we're moving down, and every bull bar gets sold. This bar got sold, and people could sell more a few points higher, and then either get out with a profit or get out break even. Then it transitions, so now the bear bars are getting bought. So now every bull bar is getting follow through, and the bear bars are getting bought, and now it's above the moving average, and that continues. The strong bear bar here and gets bought and bought and bought all the way up. So that's a sign that you're in a trend. And so thinking about that in the context of today, of the open of today, we can see there's 2 bear bars. Then that bear bar gets bought. And then we have this bull bar. So we did have these bear bars, so the market's going down. And after this bull bar here, we would expect this to be sold, right? Just like those days we're looking at. If this is going to be a bear trend, this should be sold. But it wasn't. It ended up getting follow through and more follow through. So by this 4th bar here, I could already tell something was wrong if we had been expecting a trend. Right? If I was coming in thinking this is going to be a bear trend, after seeing these 2 bull bars, I'm thinking something's wrong. And to me, after this bar 4, that's given me an indication that today's going to be more of a trading range. So because of the difficulty of bears to make money and the lack of selling after this first bar, then to me, that was a lot of two-sided trading. So it looks like today is going to be more of a trading range day. And we can see that, the first half of the day was a trading range until this breakout occurred. And really since then, we've been in this lower trading range down here. So I just wanted to bring that up as a way to think about the bars as they're forming. And, it's really important to identify if you're in a trend or a trading range. And I think that's one way that you can look at it, is what kind of follow through our strong close is getting. Like we have these bars moving up here, and then this bear bar, it's getting bought. So at least for this moment, we know we're not in a bear trend. Then this breakout does occur, but through here, these bear bars are getting bought. However, you can see there is a bit of a transition that occurs here, in that bull bars were getting good follow through all through this, but then we start to get these bull bars here that are getting this bad follow through. This bull bar here was sold. Bull bar was sold. So we know after this bar, these last 5 bars are different from what the market had been doing. So there's the little signs of what the market's doing, and kind of gives you some predictive power. So the first entry I have marked today is buying above this bull bar here. And I was talking about the opening being a trading range, but I think after these 5 bars, we could expect up at least a little bit more up. So either the market is going to get a second leg up, or it should have enough sideways trading that you should be able to manage the trade. So my thinking was buying above this bar, and we do have the 6,000 target that's above. So that's one reason to be buying. Often when you get a quick sell-off on the open like this, the market will make a few attempts to go up. So if you get a quick sell-off, a move that goes above that sell-off, then the market will usually have a little bit more up. Often it does transition into a trading range like this, but there's a good enough chance that there's going to be a little bit more up that I think it's reasonable to take a buy above here. After you get this small bear doji, I think you should stay in the trade. If it closed lower, I'd probably get out below it. But I think how it closed here, I'd rather stay in the trade. And if you were going for 5 points, if you bought above this bar, you were fine. You were able to get your 5 points above that. Now, with these bars being larger, a lot of people are probably expanding the size of their scalp. So instead of going for 5 points, they're probably going for 10 points or maybe more. So if you went for 5 points, you'd be fine. You would have gotten your 5 points there. If you're going for 10 points, maybe you would have gotten stopped out below this bull bar here, or you would have taken the full loss. So it just depends on what your goal was and how you manage that through there. You also have this little blue box drawn in, and that is showing a gap. So this bear bar, the low of that bar, and then the high of this bull bar here did not overlap. And I like to draw some indication on my chart to remind me that there is a gap there. And when we start to see gaps, often those are early signs that the market will be trending. So we can see we have this gap here, and the highest the market came back was here at this point. So that gap stayed open and never came back and filled that. And then, led to several hours of selling after that. So I have that gap drawn in, reminds me that it's possibly the start. It's an early sign of a trend. As the market moved lower, I noticed these 3 pushes. So first push, second push, third push. So we have a wedge pattern, which is a reversal pattern. So if someone was short through here for some reason, maybe they had sold this close or sold this close, then I'd want to be getting out above this bull bar. Anytime I see a wedge, I'm ready to get out above a bull bar. So I'd be getting out above that bull bar there. I do want to, keep in mind as the bars are going by here that we are in a trading range, at least for now. So when I see this bear close here, a lot of people might get excited by that and think, "Ooh, the market's going down, it's breaking out, I'm going to get short." But you have to look to your left, and the left is all of this. And we've been in a trading range actually for many bars. So when you get this big bar near the bottom, it's more likely to get bought instead of sold. That being said, some people will sell the close of this bar with the plan of scaling in higher. So they'll sell this close, and maybe they'll sell 5 points higher, 10 points higher. They'll sell into this rally up, like these 3 bars up here. And I like to keep a watch on the tails on the bottom of the bars, because if they're selling here and they're selling more higher, then their plan is either to get out. So let's say they, so let's say they sell 10 points higher, which is right here. So they sell this close, sell 10 points higher, and look at these tails on these bars. They're coming down right to where the midpoint would be for the people trying to scale in. So the people, these tails are showing me the people are not waiting and holding for the market to get back down to the close down here. They're just getting out. They're just getting out, break even, or perhaps some are even trapped into their short here as the market's going up. So these tails are showing me that the bears are struggling to get back to the close here. They're struggling to make money. They're preferring to just go ahead and get out, break even. So we have some bears that might be trapped during this, and as the market goes higher and above the moving average, a lot of them will start to get out, which often creates like surprise bars, like big bars. We didn't get that here, but that's why I had this marked above. I think this bar be fine, or this one, because there's a chance that a lot of bears will just flood and give up here, and then create a big give up bar. Once again, if you get to go for 5 points, no issue. You'd be fine getting out 5 points. This only went up 9 points. So, if you went for 10 points, you wouldn't have gotten 10 points. But you at least would have gotten out with a few ticks at some point. Once the market's up here, you'll be moving your stop up to break even plus a little bit. So at least you wouldn't take a loss on that. There's another possible wedge here. I would look at this as the first push, this high here, and then one of these highs would be the second push, and then this is the third push up here. So we have a wedge. It's not the best looking wedge, but it's a reversal pattern. So we have a wedge. Then we have this lower high double top over here. So you'd call it maybe, the close of these 2 bull bars here and here. We have a double top. So the bulls have made a couple of attempts to go higher, and they're unable to. And so now the bears are getting back below the moving average. Bulls that had bought through here, they realize the days at trading range, they're not going to be, all that eager on, uh, on holding. They'll know markets, if it's going to go down, I'll be able to buy more lower. I think in this case, they're just going to go ahead and get out below this bear bar, which is clearly what happened. So double top, lower high. Probably bulls will be getting out below a bear bar like this, closing here it's low, below the moving average. So I want to be shorting where they're getting long. I want to be shorting where they're getting out of their trade. So we have the bulls selling, and then you have the bears selling. So that's a good place to get short there. And this led to a pretty decent breakout. I was wanting to try to find more ways to get short through here, down here. I was looking at like the tick chart. Couldn't find many opportunities, and the market never did go back down. I don't know. It's 3 o'clock now. There's an hour left. Looking at this now, there's a wedge pattern here, and that might lead to more selling here. So we have a first leg down here, fairly tight, and then I don't think we'll get that in this last hour, but often in the last hour you will get surprisingly large moves like that. But sometimes that second leg is delayed like that, so it's possible we could see a sell-off here at the end of the day, especially after this wedge pattern. That's a good looking wedge, so I don't know, possibly might look for another short here at the end. So back to the orders here. I did have this marked, and this is a pretty classic trade. We're in a bear trend, a couple legs back, bear bar, that's a good place to go short. That's kind of a traditional place to go short. Anytime you're in a trend and you get a couple pullbacks, I think that's what a lot of people teach. I've looked at what a lot of people have to teach over the last 10 years, 11 years, and it's something pretty common that this is just what traders look at, and this is something that you should look at too, is pullbacks in a trend like this and getting short, like below a bear bar like that. I think if you get short below this, I think you should go ahead and just get out above this bull bar. It's not the strongest bull bar, but it is looking at a possible double bottom now, a higher low double bottom. So we have this low. Now this double bottom is higher than this low. So if I was short here, I'd go ahead and just take a small loss above that bull bar there. So those are the trades today. The market still has some elevated volatility. The bars are, larger than what they had been previous to the holidays and previous to the that big FOMC day. So bars are still larger, which means you should probably be trading half your normal size right now. If you're used to risking 5 points on a trade, now normally you have to risk 10 points or more to be in that same kind of trade. So you should be trading half or a third of your normal size, and just go like that until the market kind of returns back to the pre-holiday volatility. All right, guys, thank you for watching. Have a good rest of your day. We just have Friday tomorrow. That's the last day of the week, so we'll get another review out tomorrow, and have a good day trading, guys. See ya.